Hello, good evening everyone. Today we are discussing a theory related to the chapter partnership. So in this chapter you came to know like what is the meaning of partnership, what are the types of question like how you're going to prepare accounts related to the admission of a partner, retirement, death, how you're going to prepare P&L appropriation account, what is drawing, how you're going to record the drawing, what is the general entry behind that, okay, what is dissolution, why we are going to dissolve our partnership. This that thing, the basic thing we are going to discuss today, and tomorrow we are going to do some previous year question. So this video is basically for all. So what is partnership? Partnership is, you know this thing very well. Partnership means when two or more people join together to run a business, and the objective of the business is to earn profit. Okay, so what are the advantages? Number one advantage is more capital, because if you're going to compare partnership with the sole trader does not have so much capital, because that time in a sole trader he is the only person, but here in partnership we are having two or more people. Okay, so suppose there is a three people, and in sole trader there is only one people. So the difference is this: here you have lot of capital because you raise more capital whenever you want. If this person is the whole sole person who is taking all the who is taking everything, who is taking actively participating in the management, okay, and he need more capital. So if that person run in as a sole trader, as a sole partner, as a sole business, so in that case he don't have so much options. Or and the another thing is bank also not able to give them loan quickly, because the business is sole trading. Okay, but here in the partnership, then they have an option. Before going to the bank, they can take money from the partners for running the business. Okay, and the partner also happy to raise more capital. Okay, because they got interest on capital also, so that's why there is no problem of raising the capital. Number two is more skill and knowledge. Obviously they can share their work, they can share their responsibility. So this is advantages. Okay, but they have to share the profit also. That's a disadvantage. In sole trader, whatever the profit, it's only related to the sole trader. But in partnership, whatever the profit, suppose 10,000 is the profit, so 10,000 going to be distributed among the partners, among whatever the partners were. If there's a three partners, that 10,000 is going to be distributed among the three partners. If there, but in case of in case of a sole trader, on whatever the profit they earn from the sole trading business, they have the he is the person who is taking all the profit. Okay, now what happened, because in sole trader he is the only person who is going to be taking any kind of a decision, and whatever the consequences of that decision is, the responsibility, the authority, accountability is also for that person only, the sole trader. But here sometime what happened, disagreement may occur, because there are after all they all are humans. Okay, and their point of views are totally different with each other. Sometime it happens they are not in a same boat. So what happened, if there is a disagreement, the conflict may arise. Okay, this is a disadvantage. C part, partners cannot act independently. Here they cannot act independently. They can't say like I want to do that, so I will. No, every decision is taken care by all of the consent. If they want a new partner in a business, so consent were taken on. It is not only a thing like A wants another partner in a business, so the another partner can be admitted. No. Okay, so they can't take any decision independently even. Okay, so the thing is they don't want like there is some conflict in future, or they don't want to spoil their relation also. So for that, avoiding future conflicts, they need to prepare an agreement. Okay, partnership agreement. So in partnership agreement, write each and everything, like what is their profit sharing ratio, interest on drawing, interest on capital. If any partner getting a salary, they have to record that this much is the salary they are going to receive. Okay, so everything. But sometime there is no partnership agreement, then Partnership Act 1890 says these rules. The first one is all partner contribute equal capital. Partner are not entitled to interest on capital or salary. Partner will not change interest on drawing. Okay, charge, sorry. So here they contribute equal capital. Okay, interest on capital is not there, salary is not there, interest on drawing is not there, but interest on loan is there, which is 5%, and they share profit equally. Okay, so this is the thing you have to keep in your mind. Okay, so what are the special account you need to prepare? P&L appropriation account. What is P&L appropriation account? P&L appropriation account is the extension version of profit and loss account, in which you are going to show your partner's profit or loss. Okay, after recording all the adjustments related to the partner. Okay, so now the thing is how you're going to prepare the P&L appropriation account. For that, first of all, you need to record the profit. So from where you get this profit? From your profit and loss account. Then you have to add your interest on drawing, and you have to deduct your salary, partner salary, any commission, any interest on drawing, or any share or anything like commission and all. Okay, so these things you have to deduct, and whatever, if you're having a positive balance, it means there is a profit. Okay, if you're having a negative balance, it means there is a loss. So that profit you have to share among the partner. In which ratio? Whatever the ratio is given to you in question. If there is no information related to the ratio, it is clearly understandable thing, like you have to divide equally. Okay, so this is the example in front of you, how you're going to prepare the P&L appropriation account. First you have to record your net profit, and it is from where you get this net profit, from your profit and loss account. And generally in the question it is clearly mentioned, like this much is your net profit during the year, so you have to record it. Okay, and then you have to add interest on drawing, and except interest on drawing, everything you have to deduct it. Okay, and then you'll get a, if you get a positive value, it means there is a profit. If you're getting a negative value, it means there is a loss. Whatever the, if it is a profit, then you have to share that profit among the partner. If there is a loss, again you have to share this thing among the partner, and you are going to share in which ratio? It is given in your question. Or if it is not, then share it equally. If there is a 2 partner, then 1:1, it means 1/2, 1/2. If there is a 3 partner, then 1/3, 1/3, 1/3. Okay, so now next is drawing. What is drawing? You know, when partner withdraw some amount for their personal use, that is your drawing. Okay, and for what how you're going to calculate the drawing? You are having various methods. Okay, simple method, product method. Okay, so now we are going to discuss capital account. You are having 2 types of capital account. First is fluctuating, and the another one is fixed. Now you just only remember this thing. In fixed account, you have to prepare capital account only. Okay, in capital account, all item which is from your P&L appropriation account, you have to record it there. In fixed capital account, you have to prepare 2 accounts. First is your capital account, the another one is your current account. Okay, and in capital account, what you need to record? Additional capital, and whatever the capital you withdraw. whatever the capital partner withdraw, you have to record that much. And in current account, again you have to record the items related to your P&L appropriation account. Okay, so now don't panic. When we are going to start a question, then you're able to understand like how you're going to prepare these accounts. This is a theory lesson. Okay, this time in this video you're only getting the theory, and in theory don't expect like you can able to solve the question. You have to take some patience, because without digits, without figure, you're not able to understand like how the things is going to be, how you're going to prepare capital account, how you're going to prepare current account. Without digits it's quite difficult for you. Okay, now moving forward, when partnership changes, obviously partnership changes when there is some change in the partnership. What kind of a change we are discussing here? When partner join, suppose A and B already are partners, okay, and all of the sudden they give a consent to admit C, so it means C are going to join. So in that case you have to change your partnership. Okay, for example, if there is 3 partners and B, all of a sudden B wants to retire, or B does not want to do partnership with A and C. So before retiring, if the partnership is at will, you have to give 6-month notice. Okay, but or a public notice. If you're not going to, or by mutual consent, he withdraw their partnership from the partnership firm. Okay, and sometimes this is unfortunately sometime happen like A, B and C are partners and B is not no more. Okay, in the case of death, also the partnership changes. Okay, and sometime happens like they agreed they agreed like they will share profit in the ratio 3:2 in the very starting, and all of the sudden or mid of the session or mid of the year they decided no, that's not fair, we are going to share profit and loss in 1:1. So if they are going to change their ratio also, then also the partnership will change. Okay, so next, how you going to prepare revaluation? The thing is here we are going to discuss only the meaning, why we are going to prepare the revaluation account. Okay, from numerical question I'm going to give you a trick to solve revaluation account. Okay, no need to learn these general entry. If you know how to prepare revaluation account, if you know how to open ledger account of this revaluation account, then it's very simple, like you are able to do any kind of a journal entry. Okay, so my tip is no need to learn this journal entry now. If you want, there is in my video the journal entry is present. You just make a pause and just record wherever you want. Okay, but my suggestion is don't go for journal entry. First thing is you need to know how to prepare revaluation account, how to open the revaluation account ledger. If you're able to know that, then journal entry is nothing for you. Okay, when one of the what is revaluation account? Okay, revaluation of assets. Revaluation means when you're going to revalue means maybe the value of assets increased, maybe the value of assets decreased. Okay, and sometime happen maybe the value of liabilities increased or decreased. So this thing we are going to record in our revaluation account, and after that whatever the profit of the partner, that will distributed among them. Okay, so in revaluation account you're going to record whatever the assets increased and decreased value, liabilities increase and decreased value. Okay, unrecorded assets, unrecorded liability, these 4 things you're going to record in revaluation account. After recording this, you came to know what is your profit and loss of whom? Of partners. Okay, moving forward, Goodwill. What is goodwill? I think everyone is very much clear about the tangible and intangible assets. So, tangible assets and intangible assets, what are they? Intangible assets. Look, students, tangible assets are those assets which you can see, touch, and even feel. Okay. Any, like land, furniture, is your tangible assets. Okay. Intangible is like which you cannot see, which you cannot see, but you cannot even touch also, because there is no physical existence, but you can only feel, like goodwill, like patent. Okay, like copyright. So this is the difference between the tangible and intangible, the basic difference. Okay, so now what are the factors of goodwill, of factors affecting of goodwill? Like if your business having a loyal customers means, what are loyal customer? They shows loyalty towards your business. Okay, they come back and back for searching the product, for getting the product. Okay, so if you're having a loyal customer, it means if loyal customer increase, your goodwill also increase. If you don't have loyal customers, it means you don't have so much goodwill. If you're having a good management, obviously your goodwill will increase. If you're having a good reputation in the market, your goodwill will increase. If you're having a good supplier, your goodwill will increase through the supplier. Okay, and if you fulfill their supplier contract, obviously your goodwill will increase. Okay, well-known brand name. If you're having a well-known brand name, so it means you're having a good reputation in the market. Good location also help to increase your goodwill. So these are the factor which affects your goodwill, which affects anyone's goodwill, anyone's business goodwill. Okay, so the thing is how to record the goodwill. There are only two concepts in that. First thing is, you want to record in your book or you don't want to record in your book. Okay, if you want to record goodwill account in your books of account, so you have to pass only one general entry, that is goodwill debit. And suppose I'm taking here two partners, A and B. So A's capital account, B's capital account, credit. Okay, that's it. And here this goodwill is going to be distributed among A and B in which ratio? Old ratio. Okay, that's it. Now what happen if you don't want to keep goodwill in your books of account? Then you need to pass two entries. Okay, the first one is this and second one is this. First you need to record goodwill debit, A, B, credit. Okay, and then you don't want that goodwill, so reverse that, but with new partner, A, B, C, and goodwill credit. This debit. Okay, and here you use new ratio, and here you're going to distribute this goodwill in old ratio. So I think this difference is clear to you. Okay, this is the main. Now, okay, this is the main thing. You have to keep this thing in your mind. Okay, now again we are going to revise this thing because this is an important thing. Okay, in case of goodwill, the two question arises: are you going to record it or you not going to record it? Okay, if you're going to record that goodwill, it means you have to pass general entry like this: goodwill account debit, A's capital account credit, B's capital account credit, and whatever the goodwill you are having, you have to distribute among A and B in old ratio only. Okay, that's it. Khatam. When you're not going to record goodwill in your books of account, in that case, this entry you have to pass: goodwill account debit, whatever the amount. A is capital, B is capital, okay, and that goodwill again in which ratio? In old ratio. And now reverse this entry with new partner. A is debit, B is capital account debit, C is capital account debit, and goodwill account credit. Whatever the goodwill you are having, you have to distribute among the partner, but in which ratio? In new ratio. Okay, so I think this much is clear to you. Okay, here in this case you have to record only one entry, then in this case you have to record two entries. Okay, now dissolution. What is dissolution? When dissolution happen? Why dissolution happen? There are various cases when partners do not want to continue their partnership and they want to end their firm as well. So how they are going to end up everything? How they are going to wind up their firm? By selling their assets and by paying their liability, and whatever they left behind they are going to distribute among the partners. Okay, so when the partnership business ceases to exist, reason, maybe the firm is not a profitable firm, they are not, means from that business you are not able to earn so much, so you're going to wind it up, so that's the reason. Okay, the another reason is maybe any personal reason, or maybe someone is not feeling well at that time, also they want to wind up their company, their firm, their business. Okay, so what happened when dissolution happened? First of all, you have to sell out your assets. Okay, now whom you're going to sell out your assets, it's up to you. Okay, and who is going to sell out, it's also up to you. Okay, now what happened in a firm? If there is 3 partners, so sometime happen like this, C take a responsibility of selling out, of selling out of assets, okay, and paying all liability by whatever the amount he received from the sale. Okay, for that they charge dissolution expense, they charge some fees that is considered to be a dissolution expense, and A and B means firm have to pay that. Okay, sometimes they hire another person, okay, for selling the assets and for clearing the liability. Okay, now the question arises, whom they are going to sell it out. Again they have 2 options. Okay, either partner will take, suppose if I am a partner of a partnership and my firm is going to sell their asset and I like that asset, I can use that asset in my home, so I can buy it from there, so partner also purchase it. But it's not a compulsion on the partner that you have to purchase. They can sell their assets to the another person also, to the general public. Generally this happens through the auction. Okay, they are going to sell out their all assets. Okay, so that they can pay all the liability, and whatever the balance in the capital account they have to pay, okay, to the partners. Firm have to pay that balance to the partner. Okay, so for that you have to prepare realization account, partners capital account, and the bank account. Okay, now what happened? This is not your course question. Okay, now what happened? Again I'm saying no need to learn the journal entry for realization account. In partners capital account, in admission, retirement, and in death, okay, you have to prepare revaluation account, partners capital account, and balance sheet. And in case of dissolution, instead of revaluation there is a realization account. Instead of partners capital account, yes, there is a partners capital account, but here the closing balance carried down, and then we will make it brought down. Here the closing balance is either in the cash or in the bank, whatever they asked you. Here we are going to record balance sheet, because they want to continue the business. Okay, and balance sheet shows the financial position of their assets and liability, means how much they are having assets and how much they are having liabilities. Okay, but here all assets were gone, all liability were paid off, so no need to prepare balance sheet. Here we prepare cash book for recording whatever the cash in, how much cash inflows and how much cash outflows, either cash account or bank account. It's totally based on the questions and questions information. Okay, so I think that's it for today. Okay, I hope the little basics you're going to means you are able to understand that little basics. Okay, for more detail you need to watch some videos which is related to the numerical questions, then only you are able to apply your theoretical knowledge. Okay, so in the next video we are going to solve some previous year questions which is very much important to you. Okay, so have a nice day. Goodbye.